Previously, we've talked about consumer debt being a problem in the current economy, but now more information is out. The Federal Reserve recently reported that the U.S. consumer non-mortgage debt has never been higher. As of December 31st, 2017, U.S. households had a record $1.0 trillion of credit card and revolving loan debt, a record $1.3 trillion of auto loans, and a record $1.5 trillion of student loans. Among these, credit card and auto loans in particular have been experiencing accelerating delinquencies. So let's take a closer look. And as a lead-in, you've seen this chart before. This chart shows the four largest credit card issuing companies. DFS is Discovery Financial, COF is Capital One, AXP is American Express, and SYF is Synchrony Financial. And each of the companies has begun recently increasing their net charge-offs for credit card delinquencies. And even though the increase is only slight, that's just the beginning of the problem. So let's go to the next chart. And this chart here shows the net charge-off rate on consumer credit card loans, all commercial banks. And as you can see, from early 2015 through July 2017, the net charge-off rate has started to increase. And as you can also see by the red arrows, each time that the net charge-off rate started to increase, that preceded either a recession or a sell-off in the stock market. So let's go to the next chart. And this chart here shows the credit card charge-off rates for both big banks and smaller banks. The big banks are in blue and the smaller banks are in red. And the smaller banks comprise those banks that are not included in the 100 largest banks in the country. And the larger U.S. banks dominated the credit card issuance during this period, and they focused on the prime and super prime consumer following the great financial crisis. During that time, they also enjoyed a relatively long period of low rate charge-offs concurrent with the Fed's low rate policy. However, it's the smaller banks, those not in the top 100 by asset size, that have experienced the recent surge in charge-off deterioration, which at about 7.9% is on par with the last financial crisis. In other words, to find where the next consumer credit crisis is hiding and may erupt next, ignore the big banks and focus on the smaller ones. Even though there's a separation of the big banks and the smaller banks, to me, the smaller banks are the first domino that may fall. So let's go to the next chart. And this chart here is similar to the previous chart, with the exception that it shows the credit card delinquency rates. Again, the small banks and the big banks. Both the large and the small banks pushed into the credit card market following the recent recession, searching for higher yields and a more affluent customer base. And as competition intensified, the bigger banks splurged on consumers with the cash rewards and points that could be redeemed for vacation, hotels, flights, etc. However, some of the smaller banks could only battle back by loosening credit score requirements, but that strategy now seems to be backfiring, even though the economy is improving and the unemployment rate is near record lows. And as you can see in the chart here, the current delinquency rate is at a level lower than right before the dot-com crash. However, it's higher than the period right before the great financial crisis. So once again, the smaller banks may be the first domino to fall. Let's go to the next chart. One may say that wages are rising, but they're only rising slowly, and as a consequence, some consumers have simply taken on more debt than they can handle. And some of those consumers are struggling to pay back those credit card bills to the smaller banks. If you recall, prior to the last recession, in the run-up to that period, losses accelerated for the small banks before they did for the big banks. And then you're going to say, well, the lack of this savings and the increase in those credit card debts has spiked consumer confidence to near record highs. Well, looking at this chart here, we can see the disparity between the consumer confidence and then the savings rate as a percentage of disposable income. And when we've reached these levels of disparity, going back to the two previous periods, as shown by the blue arrows, in the first, that preceded the dot-com crash, and in the second blue arrow, that preceded the great financial crisis. And then now, the disparity, what will that precede? So for today, that's ChewDog Charts. Thank you.